Hey everybody, I want to talk about a trade we did on gold just 2 days ago, and we were able to take off for a 50% profit within 2 days. So we came out and on gold, because of the upside and what we were seeing, we did upside calendar spread. Calendar spreads basically make money if the price goes up a little bit, but they don't want the price to go up too much when you do an upside calendar spread. And so we purposefully did this, and this is what the subscribers saw. They see a strike price, see the expirations, they see the quantity, along with the position sizing that you should have in your portfolio. You don't want to put too much, but you don't want to put too little. And so we went ahead and we did this right here on GLD. And GLD is just a gold ETF, and that's the way most people will be trading gold. And we can just go out onto the one-day chart, and we can see that clearly we have had a large run-up, and we were able to catch the tail end of that run-up. Of course, we didn't just buy call options. If we had just bought call options, it would have been a lot riskier. We would have worked against time, and on top of that, if we were in a situation where it rallied up very slowly, we would have lost money. With the calendar spread, it really worked out in our favor, and that's why proper trade structure is necessary. And this is what we go over with our subscribers. We closed that trade out today for a 50% profit. What are we looking at now on gold, though? So I'm going to talk about a trade where we're doing a downside butterfly spread. And in a butterfly spread, you basically want the price to go down a little bit, but not too much in the way in which we are doing a downside balanced butterfly spread. You want the price to go down a little bit, but not too much. Likely to grind lower. And again, position sizing, we felt 5% of our portfolio was appropriate for this. So going right here on GLD, we can actually go to spot gold actually. It's going to be the best way to look at it. XAU USD, that is spot gold inside the Forex markets. And we'll go out, we'll look at the 1 month time frame. And what we see right here is that we have made a large cup, and we got so overbought at one point that we were more overbought than we were right here in 08. And we got to the point where we were even more overbought than we were in 2011, to the point where we were so overbought that we had not gotten into that high of an RSI in about 40 to 50 years. So that's how overbought we were. So we knew we needed to pull back, and that's what we're expecting, a small pullback or a big consolidation. So we know that this can't keep on going higher, even though it looks bullish long term. We will likely see a cup and handle. That's the most likely scenario. You see a pullback, and then from there, it continues higher, likely to then $3,000 to $3,500. So of course, long term is going a lot higher. But in the short term, a short term top has likely been set, and we'll get a small pullback into a cup and handle, and we'll go higher. But we know that you can get rid of an overbought state in one of two ways. So once you're overbought, you can go sideways, or you can come down. Now, if it comes down, because the fundamentals are still strong, because the positioning is strong, I don't just expect it to come to lower lows. If we do come down, it's just going to be a small pullback, I believe, because the fundamentals are very strong. Just listen to many of the videos that we made on this channel. And from positioning liquidity perspective, the majority of flows coming into gold are in the physical market and in the ETF market, not in the futures market. In the futures market, it tends to be a lot more speculative, a lot more leverage, whereas in an area like the ETF market, people tend to hold on for multiple quarters, and it tends to be a lot less speculative, and it's not speculative in the physical market where people hold on for at least years, if not decades. So there's long-term buyers, so the positioning liquidity is there with the long-term buyers, not short-term speculators, long-term passive buyers, along with good fundamentals. So if it does pull back, it's just going to pull back purely for the fact that it is overbought. And we'll get a small pullback, or it'll just consolidate sideways before continuing higher. And so we wanted a trade that could take advantage of a pullback in gold and could take advantage of a sideways move in gold. And so we did a downside butterfly spread. Now, most of you are going to say, okay, but this is for a debit. So if gold goes down, it does make money, but this is for a debit. How are you going to make money in a sideways market? That's a good question right here. The way in which we structured this, we went out about 45 days expiration. And the great thing about going out about 45 days expiration when using downside balanced butterfly spreads is that you have a theta variance trade. What does that mean? Well, at the money options lose most of their value 2 weeks before expiration. And slightly out of the money options, they're losing most of their value 45 days to expiration, and very far out of the money options lose most of their value 60 to 45 days to expiration. And so we're buying options all the way down here that have already lost most of their value. We're selling options right here, two of them, selling two options right here that are going to start losing the majority of their value right now as we speak. The option that we bought, of course, as I said, it's already lost a lot of its value. And then the option that we bought right here, that option is going to lose a lot of its value very close to expiration. So it's going to be a long time before it loses value. So if it does chop sideways, we make money, and then just 2 weeks before expiration, when these options that we sold have eroded out in value, but the options that we bought have kept their value, we can roll it out to a further expiration. And so in fact, we can make money, even though it's a debit trade, we can make money when the market trades sideways. So if the market consolidates sideways, we can make money because of the theta variance. If it goes down, we make money because of the nature of this trade where the max profit is at the short strikes. And if you guys want to keep up with what we're doing with this trade on a daily basis, we have trades like this, so many other trades. We also do a pre-market wrap, which is just a daily newsletter of what we're seeing in the markets and actionable trade ideas that we're seeing, along with Q&As, webinars, ticker requests, so you guys can request tickers for us to analyze, and so much more. If you guys are interested in any of this, Alpha Actions pre-market wrap in the link in the description below, pinned in the comments section, we are giving away a free trial. So if you guys are interested in this, go ahead, look at the free trial. You guys just go on, click on it, and then just click subscribe, and you guys get email notifications of everything we upload. Thanks for watching, everybody. Again, remember, if you guys want to keep up with this trade, any adjustments or anything we're doing to a trade on this GLD Downside Butterfly, make sure you guys go, link in the description below, pinned in the comments section, and follow us on Alpha Actions Pre-Market Wrap on Substack. Thanks for watching, everybody.